Just remember, it's when you purchase on an IPO, you're someone else's exit liquidity.
And there's really an opportunity for people to opt in instead of opting out. And I think CDFIs are a really great way to opt in to investing in community and affordability.
Welcome everybody to episode 7 of Inside the Flows. I'm your host Iyassu, and I'm here with special guest Anna Smukowski from Enterprise Community Partners. Say hi
Hi,
to everybody, Anna.
everyone. Hi. Happy to be here.
Happy to have you, and happy Friday as well. It's
Yeah. Happy Friday. First day of spring. So,
yeah, oh, March 20th. You are
yeah.
totally correct. So I'm joined here with Anna. It's been a wonderful time being able to have her in the network and invite her onto the show to talk a little bit about what she does, what her firm does, and some of the resources that they have produced over the past couple weeks. And I'm really excited to have Anna on here, and I think our audience members are going to learn a lot. I don't one of the missions of the show is to really bring to light a lot of the cool things that a lot of cool people are doing, but don't get much sunshine. So having Anna on here is a real treat, not just for me, but for the audience members as well. So thank you again for joining us, Anna.
Yeah. Yeah. Happy again to be here. So, hopefully, you'll learn something and take something away that you can action.
Yeah. So uh, we typically start our episodes with a weekly recap of what happened in the markets and our space. And so we're going to kick that off right now. Looking at the news flow this week, Monday, there was a Wall Street Journal report that came out that said that SEC is preparing to eliminate the quarterly earnings reporting for companies. And that's a big deal right there. And when they were proposing to eliminate it, they weren't exactly saying we're going to get rid of quarterly reportings, but make it optional for companies. And there's a pretty big reaction towards that. I think everyone in my circle was talking about, hey, what does this mean? Is it a good thing? Is it a bad thing? And, for folks who work in the long only shops, so those are buy side investors like mutual funds and actively managed ETFs. The quarterly reportings requirements really had some They really had some deep conversations about short termism and how companies, react towards the quarterly cycles. And what if there was a world where they didn't have to worry about that? So, that might be a possibility where the long term investors get what they've been asking for, which is, hey, we want management teams to focus on 1 year, 3 year, 5 year plans versus trying to satisfy some hedge fund in New York, for the next, quarter. So that was pretty big news. I don't know if you saw that, Anna, but
Yeah.
any thoughts?
I think it's an interesting flip too, because I think the whole impact investing and sustainable investing industry has been driven by the desire to have more data and more information. And I know, at least for us, quarterly reporting is still something that we do for all of our investors, and we see it as a way to not just share information about our financial health, but share information about our portfolio quality and the stories of the partners that we work with. And it's a key touch point. I think that it's important to think about how quarterly reporting is a snapshot in time, but if you want to look at larger trends to see the financial health of an organization. So I don't know. I don't know how I feel about that shift, especially when things like AI can theoretically make reporting easier. So it's kind of an interesting 180, at least for me. I also think, like, right now, given a lot of the underlying economic currents, I don't know if it's like the time that I want less information about the organizations that I work with. So that's another another thought that came to my mind when I saw that headline.
It's interesting because it will make reverberations throughout all of the publicly traded companies. So I think, yes, like one thing that I'm thinking about is just executive compensation plans. So if you look at a comp plan for a CEO in the S&P 500, it usually is broken down into several sections. There's like the salary part, there's the short-term incentive plan, then there's the long-term incentive plan, and there's like all other compensation, which can cover kind of like home security and some other kind of like benefits. And so, like, if you move from quarterly, to, semi-annual to annual reporting, then that short-term incentive plan goes away, and it's that starts to sound very attractive to long-term investors where they're like, "Yeah, we care about, like, the 3-year or the 5-year, horizon, not the, 1 year. That's not
Mhm.
that important to us." But then, for traders who are part of making the markets more efficient, they probably are like, "Whoa, whoa, 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 whoa." Like,
Yeah.
you telling me, like, there's, like, a potential that, I can't trade on daily news? Like, that's, it's not really good for me. So it's interesting, and I'd like to see how it goes through the SEC and the rulemaking process to see what the pushback's going to be. But I think long term investors are going to be a little satisfied with this change. Moving on to Tuesday, so Barron's wrote an article about AI and the financial advisory world, and it was coming from my one of my favorite conferences, Future Proof. So they basically covered Future Proof, which previous host Nishit and I have been just like we've been pounding the table on this. We're like this is the conference that cracks the code on making financial services conferences more appealing to go to. And so Barron's covered them, and they the topic was really on productivity minus fear. So advisory world or the investment advisory world, particularly the financial advisors and the financial planners, they're not really afraid right now of getting their jobs replaced. They're actually using AI to be more productive, which we talk a lot about this show on the show about how AI can make you more efficient, how if you're an advisor, you're gonna be managing more money in the future, and there's gonna be less, like, human resources for you at the same time, so, like, what are you gonna do?
Mhm.
And AI as a technology stack is gonna be, a pretty big solution. So, have you been to Future Proof, Anna?
No, not yet, but it's definitely been on my radar, so maybe next year. It seems like a fun conference.
I think every time I talk to you, I'm like, "Are you going to Future Proof?"
Yeah,
Have
yeah.
you heard of it? It's like, I don't know, when I was a young buck, I used to go to Coachella, and I used to always tell my
Yeah,
friends, like, "Hey, man, are you going to Coachella this year?" It's
yeah.
that same vibe.
Yeah, the Coachella of the financial advisor world. Yeah,
Yeah, yep,
yeah.
yep.
Feel like
Uh,
convincing a nonprofit to send me to Coachella of financial advisor maybe.
yeah, I'm happy to throw in a good word. I
Yeah.
think that, even if you are a nonprofit, just being exposed
Mhm,
to the people in the industry and seeing and hearing what's going on in the space could be hugely beneficial for you. You know, um, one of the parts of applying to Future Proof, or not applying, but registering, is that you fill out a profile of yourself,
mhm.
and there is a small section. It's not the biggest, but there is a section in there that talks about ESG, SRI, impact investing, and there are folks who attend the Future Proof conference that are looking for those
Yeah,
solutions for their clients, right? So these are folks who they haven't, their clients aren't really politicized on impact investing, and they need to service their
yeah,
clients. So
yeah, and I
there
think
are
that that's
opportunities.
yeah, that's something that I definitely have been leaning into in my role, not just for enterprise community partners, but for the CDFI industry as a whole. There's just definitely a mismatch between where the capital is and where capital can be for the communities that we work with. And I think everyone wants to invest in resources that serve them and their communities, and having that like educational component and even learning more about how we can bring lessons from the more traditional financial sector to kind of build those bridges so that more people can be involved in our industry is something that I really like to do. And so that sounds like, yeah, sounds like a good opportunity to do so.
Yeah. Wednesday, the Barron's reported that a judge out in Texas vacated the Department of Labor's Biden era fiduciary rule. So, what was going on was there was a rule that stated that for advisors. So this could be not just financial advisors, registered investment advisors, but bankers and insurance folks who were making recommendations for 401k rollovers or annuity purchases that they would adhere to stricter fiduciary standards versus best interest standards. And so the judge, in almost like in partnership with the current administration, basically struck that rule down. So the Department of Labor said, if anyone sues us on this new rule, we're not going to defend it. So the judge struck it down. And so for the independent RAs out there who were, a little worried about making one-time recommendations that could get them caught up in a fiduciary rule standard, lawsuit, they can kind of not worry as much anymore. And then also the bankers and insurance folks who, they wouldn't have a long term relationship with some of these clients, so the fiduciary standards seemed a little too strenuous for them. But that rule's been struck down. So for folks who are worried about the ERISA standards and fiduciary standards kicking in September, it's not going to happen anymore. That was the regulatory update for the midweek. And then we wrap up with a story that it happened last week that we couldn't really talk about because it hadn't developed, but I want to bring it up this week. So last Thursday, there was an article that came out about how SpaceX is going to be issuing or IPOing a small portion of its outstanding float, so around 3%, and that the major index funds, I think it was NASDAQ. Yeah, it was NASDAQ. They were considering rewriting their inclusion rules for a fast entry for SpaceX to get in. So for folks that don't know, there has been a really big dry spell with initial public offerings or IPOs. And coming out of COVID, I talked to a lot of private equity and VC firms out there, and the number one thing I heard from them was, "We haven't exited a company in 3 years," which is really really bad for them. And so there's a really big IPO market events happening this year with SpaceX and OpenAI's, ChatGPT and Anthropic. So these really big companies that are probably going to be worth north of $1 trillion, that there's expectations that they be able to do that, to unlock some capital or unlock a lot of gains, I should say. And so Nasdaq's thinking about rewriting their inclusion rules, and I'm sure the New York Stock Exchange is also thinking about that too, to accommodate and attract new IPOs. So that's going to be interesting. Just remember, it's when you purchase on an IPO, you're someone else's exit liquidity. So
Mhm.
be informed when you are buying an IPO. Talk to a financial advisor. Don't just watch a YouTube video and then say you know everything.
Yeah.
uh, so that's what happened last week that I wanted to bring up this week. We couldn't talk about it because we were at Future Proof, but that happened. Have you ever participated in an IPO, Anna?
No, we the CDFI industry, I think there might be a couple publicly traded CDFI banks, but for the most part, we're nonprofit organizations, so a little outside of our realm. Although we have rung some of the closing bells when we've issued public debt. So there were a couple CDFI members, probably like 10 years ago now, when the first CDFI bond was issued, that got to ring the closing bell. Um,
That's
so
that's
yeah,
awesome.
yeah, some convergence in the markets. Yeah,
Yeah, I'm out here in San Francisco, and you could literally go to any cafe and
and
overhear somebody talking about their restricted stock units and can't wait to
yeah,
IPO.
yeah, yeah. Definitely not part of our industry. We're like, yeah. So yeah, we're a lot of hippies that turned into financial people.
Hey, just trying to make an impact, right?
Yeah.
Friday, we close out this week with it's basically the same as last week. The conflict in the Middle East, particularly Iran, is driving up oil prices. The big news, to kind of cut the noise, is Saudi Arabia's. It was one of the prime ministers. I think he might have been the minister of energy. Made a prediction that if this conflict goes on and the activities of destroying oil infrastructure continues beyond April, then we could see $180 a barrel,
Yeah.
and that's pretty scary for folks. As a reminder, it's not just, gas prices going up whenever you have a conflict in the Middle East. It's when oil prices go up, that means the cost of producing something and the cost of produce sorry, I shouldn't say something. It's the
Yeah.
cost of producing anything and
Yeah.
the cost of moving anything goes way up.
Yeah.
So, inflation will definitely kick in, and that's why you don't want a conflict like this going on for too long, because then you think it's expensive now, but it'll get really expensive going forward. And just I don't mean to make light of this, but there's this interesting trend going on Instagram, and I'm sure it's going on in social media and other social media platforms. But there's folks who are going to gas stations, and after people they're recording this, but after people have left the gas, they filled up their gas, they go to their pump and then they just show how much gas they're putting in. And this is
Mhm.
happening in LA. And so, like, it's kind of funny because you're seeing it's funny and sad at the same time. It's so expensive in Los Angeles to buy gas. It's like over $5 that folks are putting in like point 0.1 gallons or like 0.87 gallons, and it's becoming a social media trend. So
Mhm.
you don't I don't know if you saw that, Anna, but like you don't want oil going up for too long.
No, you don't, but I think the one thing that I see as a little bit of a silver lining with this is despite all of the rollbacks on the push to EV and solar, like, this is showing people that having energy independence by using renewables is a way to help control costs, and I'm I think that makes me have some hope that we can actually continue the green transition because now project economics, even on a personal level, are changing if the price is so high. So different ways to think about it, you know.
Very, very, and I think we're going to
Yeah.
touch upon this a little
Yeah.
later in your section about affordability. But as households start looking at their budgets,
Mhm.
the volatility in their expenses starts to become a topic. So if the first quarter of a year, gas is like, $5 a gallon, and then the third quarter of a year, it's like $5 a gallon again. Folks start thinking like, is it really worth it to have like a gas powered, vehicle,
Or
right?
yeah.
Are there alternatives? Right? So like that volatility starts to become a question, and
Mhm.
folks start making household decisions off of that, because everyone wants a stable budget, right?
Yeah.
At
Yeah.
least stable expenses.
No, like, I think predictability too, and a lot of households just knowing if you have enough to cover your expenses for any month is it's hard when you're on a more fixed income to have that consumption smoothing. So I think that that may be a factor that we see start playing out in a lot of household decision making.
So that wraps up this weekly recap. Now we get to move on to a special topic, which is Anna, basically. So
Aw.
Anna, before we tap into the special topic, I should have I should have done this at the beginning of the show. But do you want to just introduce yourself and like what you do? And so, like, you're the managing director of impact investing at Enterprise Community Partners, and you've been there for quite some time, and you've been in the space for quite a while, so you've seen the ins and outs of it, particularly on the impact investing side. So why don't you introduce yourself to the audience so we can get a richer understanding of you, and then we'll dive into our topic.
Yeah. Yeah. So I work at Enterprise Community Loan Fund, which is the Community Development Financial Institution, or CDFI lending arm of Enterprise Community Partners. Enterprise community partners, you can think of as a family of companies that really works to address the affordable housing crisis in the US. And through the CDFI specifically, we provide early stage, low cost capital to affordable housing and community facility developers across the country. I love the CDFI world. Previously, I was at Local Initiative Support Corporation, which is another large national CDFI. And in both of these roles, I work on raising debt capital through a retail note program that allows individuals to invest in the work of CDFIs, and I also help structure new off balance sheet funds that help solve specific credit gaps with the partners that we work with. So, our most recent fund is focused on clean energy. It's called the Energy Independence Fund, and it helps multi-family affordable housing developers monetize the investment tax credit as it's sunsetting. And that's really important right now for them as a way to help kind of control costs on their properties. And I think the CDFI market is a really fascinating market for those who haven't really dabbled in it. There are CDFIs across the country. I know we're going to get a little bit more into it with some of the next questions, so I won't give too much away, but excited to be here and to share a little bit more about my industry.
Yeah, thank you. That's great intro. For folks who are less on the institutional side and more on the retail side, a lot of times when these financial services or investment shows are talking about investments, the conversation is really on stocks. It's
Hmm.
what we call equities, but the debt markets, they have a they're way bigger. First of all,
Hmm. Yeah.
they're way more complex, and there's way more variety in the debt markets and servicing debt and issuing debt and promissory notes and all that good stuff. So, having Anna on here is great because we get to hear the other side of the same coin, which is investing. So, really excited to have her on here to talk about the debt side of what's going on in this in our industry. So,
Hmm.
thanks, Anna.
Yeah.
And I also want to add, just for folks to know that the conversations that we're going to have is it's purely educational, so like do not take this as any investment advice. If you need investment advice, I've said it many times on the show,
Hmm.
just hire a financial advisor.
Yeah.
They're going to take care of you. They're in the business of helping you, so talk to them. But hopefully you'll learn a lot more on what Anna and her team are doing over here on the debt side. This past week, Enterprise released a couple of resources, one on CDFIs and then another on affordable housing. And
Hmm.
uh, we at Inflows, in our insights page, we captured one of the guides, the CDFI guide, which was super fascinating. And if folks have the time, go on the website, go on the insights page, check out the report. And then if you want to see or check out the thought leadership piece on it, and if you want to see the full report, click on the link at the bottom. It'll take you to Anna's website where you can download the full report. And it's really well done, easy to read. It makes the challenge quite understandable, and the solutions that Enterprise puts forth is easily digestible. So kudos to you and your
Hmm.
team.
Thank
I think
you.
you were the author, actually. You and who's the other person that authored it?
Brianna Flynn,
Yeah,
who's
Brianna.
also
Yeah,
on my team. Yeah. So thank you.
yeah.
Yeah. Yeah. We're excited about putting together new resources to educate the broader market on CDFIs and really use it as a launching point for people to become more familiar on how they can activate capital in their communities.
Yeah,
Yeah.
it's one of those things where in this world that we live and work in, there's so much information out there, and one of the things that I find very useful for the advisor or retail person is to put out, I call them toolkits. So like
Hmm.
your investor guide is a toolkit
Yeah.
basically on a particular topic. Those are super handy because a lot of
Yeah.
times folks just get lost and like, what is
Yeah.
this new 4-letter acronym I gotta like
Yeah.
gotta understand? So
Yeah. Yeah, I think too being at a CDFI and having gone to business school, people just think that I work for a nonprofit, and don't realize that we do pretty sophisticated finance. So I think part of my selfish reason for doing this is to help educate people too that on what we do. It can be, like you said, acronym soup, and having these digestible guides so people can actually dive in and feel like they're learning something and hopefully take away some practical solutions to things that seem like intractable problems in our country, like affordable housing.
Yeah, yeah. And so you all put out 2 pieces. One was on CDFIs, which we're gonna talk about right now.
Yeah.
Um, and, yeah, the topic was, like, really the one I wanted to bring up was this macro reality and just
Hmm.
kind of regulatory burden, but before we even get into that, on the CDFI guide, we talk about, the housing shortage from a owning a home perspective a couple of times an episode,
Hmm.
and there was pre-COVID, the home builders were building, about 2,000,000 homes a year, and then post-COVID, sorry, pre-financial crisis, they were building 2,000,000 homes a year, and post-financial crisis, it was half. It was, actually a quarter of that. And so there's a massive housing shortage, and your
Hmm.
CDFI, guide actually talks about it from a rental home perspective. So
Hmm.
you give an estimate of 7,000,000 rental homes.
Hmm.
There's a shortage of 7,000,000, for low income, renters. And one of the cool things you said is that the median home price is now 5 times the median income than it was in 1990. So, like,
Hmm.
that's pretty, kind of mind blowing to me.
Hmm.
So, like, when an advisor is explaining the housing crisis, to a client, how should they frame this from a regulatory standpoint, and you know, why does it make for what folks would call catalytic capital? So capital that it excites something from a CDFI as an absolute necessity.
Yeah, that's a great question. And another stat that we talk about in the paper is the cost of regulatory burden. And that can account to 41% of a multifamily development cost. So when you're thinking about the building a unit of affordable housing, and 41% of it is really due to processes like getting entitlements, going through and getting approval. There's sometimes a lot of pushback from community members due to something called NIMBYism, or not in my backyard, where people think that having an affordable housing development in their community may suppress their home values. And that's not true logic in a lot of senses. And just, I think the way for advisors to start communicating and talking about affordable housing is just understanding that the capital stacks to make affordable housing happen can be incredibly complicated. Some developers um, have to assemble in the teens of sources. So that is another challenge, and that increases that kind of regulatory burden because even if it's a subsidy source from a state, a local, or even the federal government, that comes with a lot of compliance that developer has um, to demonstrate and show that they're building the building to a certain standard, and that includes extra staff capacity to be able to meet those compliance pieces that also kind of factor into that regulatory burden. So I think one of the things that we try to do as a CDFI loan fund is really help developers access more flexible capital across, especially the earlier stages of financing. So we provide pre-development loans. We provide acquisition financing, construction loans, and then some bridge loans to other subsidy sources to really help facilitate the overall capital stack, and to the extent we can plug some gaps that may exist when a project is costing more than the subsidy available to build it. The other challenge that a lot of developers are facing right now is due to escalating operating costs due to things like energy and insurance in a lot of markets. Affordable housing already operates on pretty thin margins, so any kind of swing in expenses can really help or can really hinder the ability for a project to meet its debt service coverage on more of the permanent financing. So really trying to find ways that we can reduce the overall cost of the development, and that is a big strategic um, priority for enterprise going forward, is really helping kind of reduce some of the regulatory burdens and trying to find innovation um, in construction to help kind of facilitate the reduction of costs. I thought I could give an example too. I think that those really help people understand why catalytic capital is important for projects. So one of the project that is linked in the CDFI guide overview is for a project called Second Chance Center, which is a group that works with individuals returning from incarceration in the Denver area. And they wanted to build a new project that will include 128 income restricted units, with 68 set aside specifically people transitioning out of the justice system. We were able to support them, a newer developer, through grants, low interest loans, and tax credit syndication, which included something called the Low Income Housing Tax Credit, which is a federal program that is the largest driver of building affordable housing in the US. And we also were able to provide them with a standby letter of credit through a program we have called Equitable Path Forward, which helped with them securing the low income housing tax credit. And then on the loan fund side, we were able to provide them with a pre-development loan as well as site acquisition financing. And pre-development financing can be pretty on the riskier side, which is one of the reasons why banks don't always provide it. Usually it's an unsecured loan for things that may be needed to advance a project forward to even apply for the low income housing tax credit or other subsidy sources. So we like
Can you
to, yeah,
sorry to interrupt, can
yeah,
you just give an example of that?
yeah,
Like,
what an
what would this
expense is.
what a pre yeah, like a unsecured.
Yeah. So it means there's not any collateral attached to it. So it might be before our partner has been able to acquire a site. They may have a site in mind, but they need to do an environmental survey. They are trying to get initial architectural drawings, initial approval from their local jurisdiction to build affordable housing on that site before they acquire it. So a lot of those expenses are really early stage. Sometimes they're even like very initial feasibility studies or conceptual studies to help decide what the community wants to do with a site. Those sometimes will have grant funds through a program called Section 4 to really help with that, like really, really early stage that may not be part of the overall like financing capital stack.
It's like basically startup costs, right?
Yeah,
So
exactly. Yeah. Yep. And a lot of developers that will tie up, their cash flow. They might not have that much working capital to be able to tie up if they're having multiple projects going at the same time. So we also, through our Equitable Path Forward program, have an unsecured working capital line of credit that we've provided to developers across the country. And that's really meant to be like that catalytic capital to help these developers grow their portfolio without tying up their own cash resources.
yeah, and I think it's really important for the audience to understand the startup aspect that the developers have to go through is
Yeah.
really, really hard, like, and it
Yeah.
takes a lot of time. I was part of a neighborhood association, and I was a YIMBY, so not the
Yeah.
opposite of
Yeah.
not the opposite of backyard.
Yeah.
And so, the way it works is usually the city's like zoning department or zoning committee is in charge of approvals, and they will require community input. And community input means anybody that lives in that
Hmm.
area. And I'm telling you, man, if you if you care about affordable housing, you need to start going to these meetings, because there are
Hmm.
a lot of people that go to these meetings that don't want any kind of development. And I'll give you an example. So if there was like a new affordable housing development that was coming up in a neighborhood right next to mine. And so the developers were required to go and talk to all of the neighborhood associations that the city had deemed a neighborhood association. And you know, a the number one complaint from the, audience, members, which was like, I don't know, 30 people, like, it was like, okay, well, where are we gonna like, where's the new parking? Like, how, like, if there's not gonna be any new parking,
Yeah.
then we don't want this thing developed here, right? And you're like,
Yeah.
these
That's a
30
big complaint.
people wield so much power.
Yeah. Yeah.
And so,
Yeah.
like, for you to be able to, at least have some, you're alleviating some of the startup costs for developers.
Mhm.
That's a really awesome thing because, like, it is, they get put through the ringer.
They do. Yeah, and that's I mean, that's why that 41% of regulatory costs can be so high because getting through all of those community meetings and getting through the approval process can take years. There was one project that we provided financing to in Los Angeles for pre-development, I think like 17 years ago, and it was finally built. That's crazy. Like that shouldn't if we care, like if we have any empathy for our fellow citizens that need a place to live, like, that's just crazy to me. And I mean, I love in my neighborhood alone when I walk to the light rail, there's a affordable housing building for artists, that has a early childhood education facility on the bottom that a local CDFI I'm on the board of provided the permanent debt to, and I mean, I love seeing the projects that we've provided capital to in my neighborhood and seeing the kids that live in those facilities going on the school bus, like they are our community members. So I think it's important for people to remember that most affordable housing are people who are living and working in your community that just need a place to live because they don't make as much money as you do. So I don't think there's anything wrong with that. They're still contributing to society and probably doing jobs that we may not want to do. Or, they're creating the artistic fabric of our communities, and those are the places that we want to live.
Yeah, 100%. I think, one of the things our audience members kind of focus on, or care about for their clients, is if you're putting your money into these projects, what's the default rates looking like? And, could you talk a little bit about how it's not 100% safe, but, on these fixed income securities that you're working with, how they
Mhm.
can kind of compare to just prime lenders and what their default rates are?
Yeah, I mean, for Enterprise Community Loan Fund, we've never failed to repay a loan or any of our debt securities, and that includes us weathering the 2008 crisis. And that's true of many of the large CDFIs. In the report, we talk about larger aggregate stats that also include small business lenders, which tend to have a little bit higher of a default rate from their underlying borrowers. But from a from the CDFI to their lenders, the report says that the delinquency rate over 90 days is just 0.96%, and net charge-offs are only 0.58%, which, when compared to traditional financial institutions or prime lenders, is you know pretty good. So I think that's one thing to think about is our business model is really predicated on working with our community members and partners to build assets that the community wants to have and wants to see are successful. And that working in partnership with communities is one of the reasons why we really work to provide more flexible patient capital. But for our borrowers, one of the core things that we do is really work with them to make sure that their project is able to come to fruition. So we have more flexible credit boxes in times of economic distress. We're really able to work with our partner by either amending or extending a loan while they're waiting for other subsidy sources or takeout sources to be assembled. And that's really key part of our model. The other thing that is a component of being a CDFI is to provide technical assistance to our borrowers. And at Enterprise, that is specifically um, something that we do with our solutions team, where we provide technical and capacity building to developers, which may include pass-through grants to pay for salaries or pay for financial training, other workshops, just understanding the whole affordable housing landscape, either on a federal level or for a specific community. We also do trainings around green building design principles, a whole lot of other things to really make sure that the developers have what they need to be successful, especially in a time where it's getting more challenging to be an owner and operator of housing. And on the small business side, a lot of those small business lenders really work to provide technical assistance to small businesses. So they'll also have like workshops and training academies that their borrowers go through to be ready to take on debt.
That's awesome. I wanna turn to your guide mentioning the impact notes. Can you just walk our advisors into, what's an impact note and, like, what are the mechanics behind it? And, how do returns look like for impact notes?
Yeah. So Enterprise has partnered with Lisk on a series of white papers on CDFIs and how they engage in the capital markets, either through rated bond and note programs, or we've also included separately direct issue notes. Note programs are ways for CDFIs to raise capital from either retail or individual investors. Some are for accredited only, but those white papers are a pretty good overview of the different programs. And we're planning on an update this year that will include newer CDFIs that we've learned of that have either created a new program or there's just more information out there around what CDFIs issue notes. Um, they can be structured in different ways. So there are some large national CDFIs that have an S&P rating that issue notes through brokerage accounts, and those are easy to execute and hold within some of the bigger platforms. There may be limitations depending on who your financial advisor is or the state that you live in. They're registered typically either they're registered in a state either or they're exempt from registration in the state. So some states have some more challenging security laws that have made it harder for CDFIs to file. And then the direct issue notes are issued by CDFIs directly. So you go mostly to their website where they'll have information about their program, including their prospectus, their rates, and how to complete an investment application. I think the bulk of those are based on their prom note. And then there's a couple that are more similarly structured to those that are offered through brokerage accounts, but they're still available directly from the issuer. And with that, there's really a mix of CDFIs that have both market and below market rates. Typically, the ones that go through the brokerage accounts price off of similarly rated corporate debt. So those are more comparable to like a bond that you may buy from, I don't know, what's a corporate issuer that we like I'm totally not going to be able to think of any.
You could always use the largest
You say
one, NVIDIA.
yeah, no video. Yeah. But then the other, I think with the direct issue notes programs, the they offer below market rates largely to be able to keep their cost of funds low, and that rate is what drives essentially the rate to a borrower. So we try to keep cost of capital as an industry as low as possible to be able to provide our borrowers with more flexible and low cost debt so that they're not paying a lot for holding costs or other things that we don't really want to pass through to them. So that's part of our mission and something to think about as an advisor or as an investor when you're looking at CDFIs is what are the return expectations, and if there are pots of money that individual may have that they are okay with it being more of like a capital preservation, or they want it to just keep up with inflation or be more comparable to what they may be getting in a CD account. So some of the ways that I like to explain the below market returns is more of an impact first return. So you're still getting your capital returned and you're getting some interest. It just might not be as high as what is you would get from a corporate bond.
Yeah, it's interesting because, just on the returns, um, conversation, there's taking a step back, there's this generational wealth transfer that's
Mhm.
happening, like, trillions of dollars are moving from, like, the silent and baby boomer generation to, like, the millennials and Gen Zs and Gen Ys and whatever the next one is
Yeah.
called. And one of the big concerns that advisors have is they're not capturing that next generation once the current generation of clients have, passed away.
Mhm.
that next generation is going either DIY or they're going to another financial advisor who is not so well connected with their parents. And so one of the struggles that they have is connecting with this next
Mhm.
generation. Morgan Stanley, it was like 2016 or 2015, it was a while ago, but they put out this like um, report where they showed, who knows about ESG, and they broke it down into, what was it? It was generations, like millennials, and then baby boomers, and in the middle, there was a graph of, like, financial advisors, and so, like, it was like the 2 generations knew a lot about ESG and impact investing and all that stuff,
Yeah,
and then
in the
the
middle.
advisors, like, didn't. Yeah, it was like,
Yeah.
basically, they didn't care, right?
Yeah.
And I'm sure they updated that study, but,
Yeah.
yeah, if you're trying to capture, like, the next generation of, really, like, conscious, like, these kids are smart, like, they
Mhm.
know their money has an impact, and they care about things like climate. Like, climate's something that, like, all the kids are, like, losing kinda sleep over. Uh
Mhm. I mean, I am.
One of the similarities that, impact investing has is with charity, right? But you
Mhm.
can't, as a advisor, it's really difficult to say, "Hey, you should put your money to all these charities," when the kid has, not even been in the workforce for that long. So they're looking to grow
Yeah.
their this is a good, I don't say alternative or substitute, but this is a good conversation to have to say like, "Hey, you can allocate small portion
Mhm.
of
Mhm.
your income towards, these impact notes that, will satisfy that concern you have that goes outside of just, generating, wealth, right? And we could still have you in a normal, 60/40, whatever that rules they have. It's probably changing now to 60/20/20, but we can put you in the normal stuff, and you'd be surprised how little capital in the impact space can make huge impacts for
Yeah.
communities on the environmental and social side.
Yeah, and I think with that too, there's our trade association, Opportunity Finance Network, just put out a research brief on how CDFIs can engage with donor advised funds. And there has been an uptick on how people can use some of that capital to invest in things like CDFI notes where they already had their tax event. They that money is set aside for charitable purposes, but they may be planning out a larger giving strategy. So similar to what we think about as having our portfolios valued aligned, how are your DAF assets value aligned? And I think CDFIs make a lot of sense for those assets since they're lower risk and helping achieve overall charitable objectives while you're thinking about your larger giving away strategy.
Yeah, so for folks who don't know what a donor advised fund is, it's a way for folks who have, experienced a lot of, wealth generation to donate in a tax advantaged way to a
Hmm.
charity. And so what they would do is, it would be in the form of not just like cash, right? A lot of times it's like in a security that they would donate that has a lot of value, so like Google or
Hmm.
NVIDIA.
Hmm.
And once they, donate it, they can allocate that, donation towards whatever the DAFT is, has partners with in there. Think of it as
Hmm.
like a marketplace. There's like, an environmental one, there's a social one, there's, all these different institutions that are trying to achieve a specific impact. And you can allocate towards those institutions which have been pre-vetted by the DAFT,
Hmm.
or you can tell the DAFT yourself, "I wanna donate to this institution," put them on your platform. And
Hmm.
so they're becoming wildly popular for ultra high net worth individuals to want to, donate to a specific charity, but don't have the right vehicle rather than just writing a straight check to them. They can do it to this, donor advised fund and then immediately get the tax benefit, of that donation. So
Hmm.
they're becoming very, very popular.
Yeah. They're very popular, but they also have a lot of assets just sitting there. So I think it's a huge potential. I believe that there are a large number of DAFs that are only like $100,000. So they're not always like the largest. vehicle. So there's different ways to engage, I think, as a tax planning conversation.
So that brings us towards the end of the show. I want to get to the last section, which is my favorite section of the show. And I asked this of all my guests, Anna. So what are you looking forward to next week?
Yeah. I mean, one of the things that it's more what am I looking forward to on the aggregate? And I think a lot of these conversations that I've been having where people are really concerned about how their portfolios are value aligned. And there's really an opportunity for people to opt in instead of opting out. And I think CDFIs are a really great way to opt in to investing in community and affordability. And related to the affordability conversation, there have been large moves with a new law called Road to Housing that passed in the Senate last week and is going to the House. And it's the first large change to affordable housing legislation since the 1990s. And it could bring a lot of new resources to our industry that help also reduce the regulatory barriers. So I feel like it's the time now to really lean in and think about how you can participate in the affordable housing and community development industry. And there's a lot of opportunities and a lot of different ways to engage.
That's awesome. Yeah, we'll keep an eye out on that too, and
Yeah.
probably have some conversations
Yeah.
once everything's
Yeah.
gone full send.
Yeah.
No,
Hopefully it gets signed into law.
yeah,
But it is bipartisan, which is also hard in this time. So it's nice that there's something that is bipartisan, you know,
yeah, yeah. I mean, affordability is like the number one
one
topic
issue.
of every household, right? So
Yeah.
it makes sense that they're going to solve this one of all things to
Yeah.
solve. Like, yeah, solve this one.
Yeah.
Uh, I want to thank Anna for joining me on this
Yeah.
episode 7 of Inside the Flows. If you want to keep the conversation going, feel free to join Inflows. It's exclusive to registered investment advisors. But for those folks who want to take a peek into some of the resources that we talked about today, again, go to the website, check out the Insights page. If you want the full guide, there's a link at the bottom of the post, and you'll go to Anna's website, and you'll be able to download the guide. So, I want to again thank you, Anna, for joining us, and we'll catch everybody next week.
Yeah, thank you so much, Iyassu. It was great to talk with you today.
All right, bye now.
Bye.